Welcome back, class. This video is an introduction to flexible budgeting from Chapter 9. And I'm just going to put this up as a PowerPoint slideshow. And I'll talk about some of the things, and we'll go back at points to calculate this and show you how the worksheets work, and also demonstrate through a problem or two how to actually calculate a flexible budget and the variances that we need to deal with from there. So to start with, we want to look at the variance analysis cycle. And what this refers to really is when we actually start, we're looking at, okay, what did we actually spend versus what we wanted to spend? That's where we begin. And we call that a performance report in flexible budgeting. So we're going to compare what were the actual results with our budgeted results. But we're going to look at that in a couple of ways to analyze these variances and become more specific about why the variances are there. So we can look at the variances just on the basis of what our actual results were compared to what we budgeted. But what we want to do is raise questions about what those variances came from and break those down a little bit further. And so that's what we do in flexible budgeting. So we want to start with a planning budget and a flexible budget to understand how these two are different from each other. So most places we start with a planning budget. We have one planned level of activity that we're aiming to achieve. So when we actually base our budget on one planned level of activity, it may be a little more difficult to measure, especially when our activity level does not match what we planned. So we may be prepared for any activity. When we use a flexible budget, it will help us to be prepared for any activity level in the relevant range. In other words, a flexible budget will allow us to adjust the planning budget based on whatever activity level we have. We will, through the flexible budget, show costs that should have been incurred and the actual level of activity, and really compare an actual apples to apples basis. It'll be a fair comparison. It won't be distorted. So here's an example that they give us in the PowerPoints. It's Larry's Lawn Service, and they're providing lawn care, and they have a budget plan for 500 lawns. So as you can see, here's the planning budget. They estimate revenue at $75 each for each lawn. So you have 500 times $75 to get the income. And then wages and salaries are going to be based on a flat $5,000 fee plus $30 for each lawn. So you're going to do that calculation. It's a mixed cost. You want to start with a 5,000. So you're going to say 5,000 plus $30 times 500 lawns. Gasoline and supplies are going to be $9 per lawn, so you take 9 times 500. Equipment and maintenance, $3 a lawn, that's 3 times 500. And the last set of expenses here that they show are what we would call fixed expenses, in that they don't have any connection with the volume of activity that we're actually performing. So the planned budget shows, or at least in this case, a net operating income of 5,000. It's estimated. So when we have the actual results come in, you see that Larry mowed 550 lawns. They had revenue of 43,000, net operating income of 6,450. On the surface, when we just compare the actual results of the planning budget, it looks like we had a very favorable revenue variance. That's what this means. F is favorable revenue, U is unfavorable. Anytime revenue is over what we planned, it's always a favorable budget. Anytime expenses are greater than planned, it's always unfavorable. So we see a favorable revenue variance, unfavorable expense variances for these two, favorable here for equipment maintenance, and favorable here for office and shop utilities. Unfavorable for insurance because it was actually a little higher. And then our total expenses are unfavorable, but we have an overall favorable net operating income variance. What does that mean? Well, these variances are occurring because, in part, we have a different level of activity, and some of it may be based on spending, but some of it may be based on the activity level. So, what we want to do with a flexible budget and in our evaluation of it is to identify the differences here. The question that they ask you here, if these unfavorable variances are here, does that mean Larry's done a poor job controlling costs? Uh, and since there's favorable variance here, does it mean he's done a good job controlling costs? And the answer is we don't know because we want to compare apples to apples. We need to do a comparison based on a flexible budget. So here's what we do. We say, okay, let's create a flexible budget based on the planning budget, but adjusted for the level of activity that Larry actually did for that month. So if we do that, what we're going to do is we're going to change our initial budget for revenue because we're now budgeting for 550 lawns. We're going to change wages and salaries, gasoline and supplies, equipment maintenance. These costs will remain the same, but these will change because the quantity changes. So when we look at the variances between the flexible budget and the planning budget, we're really looking at an activity variance because the only reason that these are going to differ is because the activity levels are different. So let's take a look at that. The planning budget was at 500 units. By the way, that does not change. The planning budget will not change. And the reason that this is called activity variances is because we've adjusted the planning budget for the activity level difference to identify what these variances really are. So when we adjust for those differences, we see that the flexible budget comes out with a favorable revenue variance of 3750. And it's not unusual to expect that these three costs are going to be higher because remember we changed the quantity from 500 to 550, and therefore these are going to be expected to be unfavorable variances. If you increase the volume of activity that drives the cost, you can anticipate an unfavorable variance. That's exactly what happens here. So what we see is the activity and revenue increased by 10%, but the income, or net operating income, increased by more than 10% because the fixed costs did not change. So what you see here is this is based purely on planning budget versus flexible budget, which gives us only the activity level variances. So for the next step, we want to actually look at revenue and spending variances, and these are going to be based on the actual revenue compared to the flexible budget revenue, and the actual cost compared to flexible budget cost. So what we're going to do is we're going to take that budget, the planning budget adjusted for the increased activity, and compare it to our actual costs. And once we do that, we've eliminated any change that can occur because of the change in level of activity. That is, the initial planning budget was for a lower level of activity, But since we've adjusted that in the flexible budget, now we're at the level of activity for our actual results. So now we compare what we anticipate with a flexible budget based on the planning budget with our actual results. And we see, okay, well, we have no difference in this activity level. So therefore, there shouldn't be any difference in revenue or other items that are driven by these variable costs, okay? But what you see here is there's a difference between the actual revenue and the flexible budget based on this $75. What does that mean? Well, it could be that they've mowed some lawns that are bigger than the standard $75 charge, and therefore they have an increase in revenue. This is a favorable variance in revenue, so we're not really going to complain about that. We're just going to say, okay, we had some increased revenue here, and we're going to call that, like they said back here, this is a revenue variance because of the difference between actual and flexible. If it's a cost between actual and flexible cost, there's a spending variance. So for the first variance that we see here, it is a revenue variance, and it's based on the amount of revenue we've generated and not based on the difference in activity levels because we have basically kept that activity level the same. Now, when we go down here to look at these costs, these expenses, wages and salaries, equipment maintenance, and so on, we compare the actual results to the budget. And if the actual results are higher than what we budgeted in expenses, it's not favorable. If the actual results are higher than the budget for revenue, it's always favorable. But in this case, we have wages and salaries coming in with a much different cost. We have a different cost here. We have $2,000 variance. That's unfavorable. And then we have gasoline and supplies with a $150 unfavorable variance also. When we move down into equipment and shop, office and shop utilities, we see favorable variances. And then finally, the insurance is unfavorable. And overall, we have a total expense variance that's not favorable. Now, what is interesting here is even though we have a favorable revenue variance here, we have a net operating income that's an unfavorable variance. That means we have $200 less in actual net income than what our flexible budget suggests that we would have at that level of activity. So what we're doing with revenue and spending variances is we're eliminating the difference in activity levels, but focusing on what may be a difference in pricing. So we don't know that because we haven't calculated price variances here. But one possibility is that the pricing for salaries had to go up because competition required it. You may have had to pay more for somebody to come to work for you. Gasoline may have gone up in price. That may have been part of what happened here. And insurance rates may have increased, and that may have been what happened here. We don't know that for certain. There could also be other changes, like a change in the policy for insurance coverage. But again, and in here in wages and salaries, if you were mowing larger lawns, it would require more time on the part of your folks mowing, so it may have cost you a little more there. So those are some variances and some ways of looking at them. Now, the performance report is what we're going to end up with here in this video. And we're going to actually do a calculation of a performance report. So when we actually look at this, a performance report is going to be a three columns, planning budget, flexible budget, and actual results. And between the actual and flexible budget, we're going to isolate the revenue and spending variances. This is the part of the variance that is attributable to either the revenue or spending, and not necessarily related to a change in activity level. It's not. The activity level is the same. However, the difference between planning and flexible budget is always an activity variance, because the planning budget differs in its level of activity from what the flexible budget will be. So when we set this report up, we're going to start with the item over here, description, what the formula is for that cost, the actual results that were reported, and then skip a column in between, put the flexible budget in, skip a column, and then the planning budget. When we calculate the variances between planning and flexible, the activity variances are always going to be between the planning and flexible, because the planning budget is at a different level of activity than the flexible budget. However, when we compare actual with flexible, the flexible budget takes the planning budget and adjusts it for the actual activity level in an attempt to identify what variances in here are related to spending rather than, or maybe revenue or spending, rather than a change in the level of activity. So when you look at these and you see these variances that occur, you can identify what portion of it relates to activity level, what portion of it relates to revenue or expense. So this is showing you the calculation of these variances. All right, I'm going to stop this PowerPoint here, and we're going to go back and take a look at a couple problems that I have. The first one is this one that says Kentucky Cats offers pilot training classes. Data concerning the company's operations in July appear below. The company measures its activity in terms of flights. So what they've done is they've given us the actual results, the flexible budget, and then the planning budget. Basically, they've set this up in a performance report format for us. And what they want us to do is to prepare that performance report that includes identifying what the revenue and spending variances and activity variances are. So we're going to start here with the activity variance, okay? We're going to look at activity variances between these two, between the planning budget and the flexible budget. So we want to begin by showing the difference in revenue. And so we have the flexible budget at 23,375 and the planning budget at 24,200. This is going to create a variance. Let's see here. We'll take this number minus this number. We get a variance of 825. What we want to do is identify whether this is favorable or unfavorable. Let me do this real quick. And make this a little smaller. So if the actual flexible budget revenue is less than the planning budget, it will be an unfavorable variance. That will always be the case, okay? So because we had originally budgeted 88 flights, we actually had 85. We can attribute this difference, $825 less, to the number of flights times the revenue. So we had 3 flights at 800 or 275. That'll account for the difference in revenue that we show here. So when we go to our next level of comparison, we're going to look at these expenses. So we're going to take Again, we're going to take the actual planning budget compared to the flexible budget. We're going to take the planning minus the flexible. We get $255. Now, the planning budget being higher than the flexible budget now means this is a favorable variance. That is, our costs are lower than what we originally planned. Anytime our costs are lower than what we planned, it's favorable. Anytime they're higher than what we planned, it's unfavorable. Likewise, with revenue, anytime our revenue is below what we planned, it's unfavorable. But if it's above what we planned, it's favorable. Okay. All right. So let's take a look then at the next item, the fuel. And it stands to reason that with lower activity levels, these are going to be below what we originally planned. I have a mistake here. So take this, subtract the 37.40. We have a $132 variance that's also favorable. It's below what we originally planned. We have a $75 favorable variance because it's below what we originally planned for airport fees. We have aircraft depreciation. We have a higher amount than what we have a lower flexible budget amount than what we had planned. And I believe I made a mistake in typing this. This should be 1848 instead of 2848. Okay. That makes our variance much more reasonable and in line with the other variances. So we have in the planning budget 1848 for aircraft depreciation, but 1785 in the flexible budget. That means we have a $63 favorable activity variance, and we'll have a favorable activity variance when we go to office expenses as well of $6. And then we have a total, which we're going to actually add these variances up. Oh, what did I do? Okay, I know what I did. Equals sum. We add those up, we get a $531 favorable variance in the activity level for these expenses. And then we're going to take the difference between the revenue and the expenses, and we get a $294 difference. And what that means is this is 294, the flexible budget is 294 less than the planning budget, and that's income, so it's unfavorable. If it's income or revenue and it's less than what we planned, it's unfavorable. Keep that in mind. Okay, then that's the activity level variances for this problem. Now they want us to calculate the revenue and spending variances, and this is comparing the flexible budget with the actual results. So here, we're going to take the actual results and subtract out the flexible budget. We get a $425 amount that is higher than what we anticipated. Therefore, it's favorable. Okay? Anytime revenue is higher than what we thought we were going to have, it's always favorable. Then we're going to take the 11,700, the difference between 11,700 and 11,725. The 11,700 is below what we intended to spend, so this is going to be favorable. Again, if expenses below what we planned, it's always favorable. And then the fuel, we have an unfavorable variance because we're going to take the amount that we spent on fuel minus what we budgeted, and it's going to be $60 over what we originally planned. So we had $3,740 budgeted for fuel. We actually spent $3,800. That means we have an unfavorable variance. Now, when we get to this part, we're not going to have any variance, so it's not going to really give us anything to compare. This comes out exactly as we planned, so there's no change or no difference in that at all. However, when we get to the office expenses, we have a variance where the actual results are higher than the flexible budget, and that means this is unfavorable. Our total variance, we're going to add these up. We can't simply add these because they're not all the same variance. We're going to add the unfavorable and subtract the favorable. So we'll do equals this plus this minus this. That gives us the actual variance. If these variances differ, if they go from favorable to unfavorable, we cannot simply add them. There are differences in their value. So we have to add up, let's say, the unfavorable variances and take away the favorable to arrive at the net difference. In this case, it's a $60 unfavorable variance because the expenses are higher than what we budgeted for in the flexible budget. If we compare the revenue, or net income, with the flexible budget, we get a $365 favorable budget variance because the revenue is actually higher than what we anticipated. So that is the flexible performance budget, and that's how we do that. We compare the activity level variances between the flexible budget and the planning budget, and then we compare the spending and revenue variances. So we could put revenue / spending variances here. So that's the difference between the two. Okay. The last thing I want to show you in this video is this number 2 demonstration problem where it says Bud's Bus Company operates bus tours of the Finger Lakes in New York State. Management identified 2 of cost drivers that are involved. The first one is the number of trips, and the second one is the number of passengers. The company runs 2 trips every day from March to October and can accommodate up to 85 passengers on the bus. Data concerning the cost formulas appear below. Basically, these are the cost drivers they've calculated. They say bus operating costs amount to $400 for the $1,400 for the month, plus $27.50 per trip, plus $1.25 per passenger. Advertising is fixed. Admin costs are fixed at $2,200 a month, plus $14 a trip and $1.25 per passenger. Insurance is fixed. The company's sales should average $8 per passenger. In March, the company provided 62 trips and served 4,340 passengers. Compute the flexible budget for the month of March. So we're going to start out with revenue here, and we're going to take $8 times the number of passengers. Let me do this. Let me do it this way. Equals $8 times the number of passengers. And we get 34,720. Each passenger is paying $8 per trip. So then we wind up with expenses, and we have the bus operating cost. Remember, we start with $1,400 plus the number of trips times 2,750 plus the number of passengers times 125. So we're going to create a formula here. We're going to say 1,400 plus 4340, or no, 62 times 2750 plus 4340 times 1.25. Okay, it calculated, but it didn't like it. I know why. But anyway, I didn't need the second parentheses. But what we're doing is we're saying that this formula that they gave us actually would read something like this: 1,400 plus 62 times 2750 plus 4340 times 125. And that's, I mean, that's really what we're doing, okay? It's a mixed cost. This is what we would have called earlier a mixed cost. And we're just calculating the fixed portion of that. I got 140 down, 1,400. There we go, 1,400 plus 62 times 2750 plus 4350 times 125. For our next cost, advertising, there is no variable portion of the cost. It's just $1,800. For admin costs, we're going to have, remember here we have 2,200 plus $14 times 62 trips plus 125 times 4340 passengers. And actually, in this case, we would need to bracket off these because we want the order of operations to work here. We want to do the multiplication before we do anything else. But that's how this formula would work. And when we actually do the calculation, we have 62 times 14 plus 4340 times 1.25. We get $8,493 as the admin costs, okay? And then the insurance we have is a flat rate, $2,785. And so our total expense then, we'll sum these up. We have a total expense of $21,608. So that means our net operating income after revenue is $13,112. All right, so that really takes care of what we were looking at in terms of flexible budget for this time. What we're going to do, or what I'm going to do, is I'll post this video, and for the next time on Monday we will meet using WebEx, and I will go through another problem or two like this and set you up for the Foundational 15. If there are any questions in the meantime, please feel free to send me an email. But I hope that these problems make sense, and certainly I will post these worksheets and the problems so that you can take a look at them online. I look forward to seeing you guys again next time on WebEx. Take care.